you for joining me. My name is Diana Oddi, and I'm the Director of Marketing, Communications, and Practice Management at Mandeville Private Client. It is an honor for me to be here once again this year at the Women's Collection Financial Literacy event, so thank you for having me. While the financial crisis has caused unprecedented financial challenges for many women in terms of financial stress and job stability, it has also sparked motivation. According to a 2021 Women and Investing study by Fidelity Investments, there is a 50% year-over-year increase in women investing outside of their retirement, a 43% increase in women opening up investment accounts, and a 37% increase in women reaching out for financial guidance. Also, 9 in 10 women are ready to take proactive steps over the next 12 months, with 62% eager to boost their knowledge on financial planning and investing. So this financial literacy event certainly comes at a great time. And my hope is that it will provide you with significant value in terms of heightening your financial literacy and providing you with insights to make informed and effective investment decisions, all with the ultimate outcome of wealth creation. For women, wealth creation really is a means to a number of ends. Whether you're looking to fund a post-retirement lifestyle, leave a lasting legacy for future generations, or have a social impact in your own community, wealth creation is the priority and really can help us to fund all and help us achieve all of our life's goals. So with that, I am going to review with you the principles of wealth creation. Okay, now, if you want to be successful at any endeavor in life, right? Whether it be if you want to be the best athlete, parent, investor, anything, there's a simple 3-step process. Number 1, you want to identify a role model. You want to get their recipe and follow it. And number 3, don't change it, right? So the same applies for wealth creation. If we're all here to become better investors, then the first step we need to do is identify a role model. Who in our society has successfully created wealth? Well, who would be an investor role model? Well, if we're looking at the world's most wealthy investors, who comes to mind? Well, Warren Buffett naturally comes to mind. You also may want to consider some of the world's largest institutions, like CPP in Canada. We have Ontario Teachers Pension Plan. In the States, we have Harvard Endowment Fund or Yale Endowment Fund. So if we were to look at how their portfolios are constructed, we would see that they all have a combination of both public and private investments. If you looked at Ontario Teachers Pension Plan, you would see that they have a combination of both public and private investment. OMERS, public and private investments. Canada Pension Plan, again, public and private investments. Yale has upwards of over 78% in private and alternative investments. So there's a common theme here amongst our investor role models. Our investor role models are all investing in a combination of both public and private. They're all creating wealth by investing in a combination of both public and private investments. Yet, if we were to look at the typical investment, the typical portfolio for a typical investor, you would see that their portfolio is comprised of 100% public investments. So there seems to be a gap between what the investor role models are doing and what the typical retail investor is doing. So you want to ensure that if you're working with an advisor, that you want to explore whether or not you can obtain access to the same investment opportunities typically reserved for our investor role models, for the world's wealthiest investors and institutions. And so when we talk about Warren Buffett, right, some would say he is the quintessential investor role model, or he's probably arguably the most successful investor of our time. So when it comes to investing, Warren Buffett has been quoted with saying the following: to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep one's emotions from corroding that framework. So yes, so essentially Warren Buffett is saying to be successful at investing, you need framework, you need control of emotions, and you need access. And certainly all of these things need to be working for you at the same time. You can't have one out of two or two out of three. You need to have all three working for you. So let us take some time now to explore framework. So again, referring to our investor role model, Warren Buffett. When Warren Buffett was asked, how did you become a master asset allocator? Okay? He responded by saying, I am a better investor because I am a businessman, and I am a better businessman because I am an investor. So therefore, if we want to be great capital allocators, we also must think and act like business owners and investors. So keeping that in mind, if there was a formula or a recipe for wealth creation that all of our investor role models apply to create wealth, certainly we would want to know what that formula is and apply it to our own portfolio. Well, we've determined that there is such a formula, and we call it the 5 laws of wealth creation. So let's go through a little exercise. If you took a moment and thought of the wealthiest person that you can think of anywhere in the world, I would suggest that this person did 5 things consciously or subconsciously to create their wealth. Okay, but there are 3 rules before we start. That person you're thinking of had to have created their wealth, not win it, not inherit it, or not win it, inherit it. Okay, so let us, or marry into it. That was the 3rd one. It slipped my mind. Okay, so as we go through this list, keep that person in mind. Now, number 1, I'm confident that that person that you're thinking of created their wealth by owning just a few high quality businesses. Number 2, I'm confident that that person would have created their wealth by thoroughly understanding those businesses. Number 3, those few businesses are in strong long-term growth industries. Number 4, they use other people's money prudently. And 5thly, those few businesses are held for the long run. So these are the principles of wealth creation. And when we're looking at an investment opportunity, we want to judge the merits of that investment opportunity on these 5 principles. Right? We want to ensure that it checks all 5 boxes. And if it doesn't, we simply don't want to pursue that investment. And if you're working with your advisor, you want to consider, are they working with an investment framework? Have they reviewed the principles of wealth creation for you? Because I would suggest that if your goal is wealth creation, then the principles of wealth creation should certainly be one of the first conversations your investment advisor has with you. So if we were to take a step back and look at this framework and see how it fares against a typical investment that an advisor or that an investor would purchase as a vehicle to create wealth, and see how it fares. So let's take a mutual fund. If you were to take a typical mutual fund and let us see how it fares against the 5 laws. So number 1, a typical mutual fund has actually upwards of 200, 300 businesses within the mutual fund. So it fails on the first account. Secondly, how can you be confident that that portfolio manager thoroughly understands 300 businesses? Not possible. So it fails on the second account. And thirdly, How can you be confident that those 300 businesses are all domiciled in strong long-term growth industries? Again, some may be, but others, how do you know that all can be in strong long-term growth industries? And fourthly, are you confident that the CFO of those 300 businesses uses, other people's money prudently? Again, fails on the fourth account. And on the fifth account, the typical hold period for a business within a mutual fund is 18 months. So again, how is it possible for that portfolio manager to thoroughly understand 300 businesses 18 months? Not possible. In fact, I can't think of one investor role model that sells their business every 18 months. So again, it fails on the fifth account. And if you're not investing, you're speculating. So you can see the importance framework has, right, when making your investment decisions. So when you make an investment decision, you want to ensure that it's in alignment with the principles of wealth creation, with this framework. So let us take it a step further now, and let's shift our attention from that person that you were thinking of, right? That investor role model, that wealthy person, to focus your attention now on the business that they own to create wealth, on that wealth creating business. And what I'm going to do is I'm going to describe 10 characteristics endemic of a wealth creating business. Okay, so keep that business in mind. Number one, that wealth creating business, the owner and the operator are one and the same. Number two, the ownership of that business is heavily concentrated. So there are maybe 1, 2 owners, and they have a significant portion, and they likely have a significant portion of their net worth tied into that business. Number three, there's personal identification between the business and the owner and the owner and the business. So if you were to think of Bill Gates, likely Microsoft would come to your mind. And likewise, if you thought of Microsoft, you'd likely think of Bill Gates. So again, personal identification between the business and the owner and the owner and the business. And if we go on to management style, the management style in successful wealth creating businesses are often autocratic. So oftentimes, whatever the owner says goes. They may consult with their team or their board, but at the end of the day, the final decision is theirs. Number five, they have an entrepreneurial management style. When that business owner wakes up in the morning, she's thinking of growth. Right? Her last thought at the end of the day is growth. She has a growth mindset. She's always thinking of ways to grow her business. And there is low turnover in management, right? So the team that she surrounded herself with believes in the mission, believes in the vision of the business. They're invested. They're all facing forward, moving in the same direction. And when it comes to management, risk and reward, it's symmetrical, right? So if that owner makes a good decision for the business, the net worth of the business goes up. The net worth of that owner goes up, right? Because their interests are aligned. Likewise, if they make a bad decision, the net worth of the business goes down. And if a detrimental decision is made, right? The business could lose everything, right? The owner could lose everything. So it's just like flipping a coin, heads you win and tails you lose, right? So that team is highly motivated to make only the best decisions for that business. And the business sets goals for the long term. The board focuses on growth. Again, they know what their plan is 5, 10 years, 20 years down the road. They're always thinking of the long term. They're thinking of growth. And the valuation of the business is based on the true fundamentals of the business, like sales, market share, margins. It's not based on the forces of supply and demand, right? The emotions of the market. It's based on the true fundamentals. So what we have here are 10 characteristics of a successful wealth creating business. And it forms an extension of our framework. So when you're, again, Faced with an investment decision, you want to ensure that it checks the 5 laws of wealth creation, but it also is as closely aligned as possible with these characteristics. And that's if you're looking to buy a private business or a public business, you want to ensure that it is in alignment as closely as possible with these characteristics. Now, if we move on to the second component of successful investing, it's the control of one's emotions. Now, this is equally important to all other components. So it is very important that, in times of crisis, we often feel, especially we've experienced in the last 18 months, 24 months, when there's a period of crisis, we often feel stressed, there's angst, but we must always remember, in times of crisis, there are always opportunities. In fact, there's a Chinese adage that says crisis equals danger plus opportunity. So when it comes to investing, the danger is that, we react emotionally, right? But the opportunity is that oftentimes when the markets are volatile, this presents an opportunity to invest in quality businesses, again, that reflect the 15 characteristics we discussed. Oftentimes it presents an opportunity to purchase those businesses at a discount. So we must make sure, right, that we control our emotions. And really, framework plays a significant part in the control of one's emotions. And lastly, you want access, right? You need to ensure that you have access to qualified investment professionals that can provide you with access to a sound investment framework and access to quality public, private, and alternative investment opportunities, typically reserved for our investor role models, for the world's wealthiest individuals and institutions. If you have these 3 elements, then you are well on your way to being a successful investor. Thank you for joining me.
The wealthy invest differently. At Mandeville, we understand this and have made it our mission to provide all wealth-seeking investors with access to high-quality public and private investments, typically reserved for wealthy and institutional investors. Access to high-quality private investments, such as private debt funds, have shown to decrease portfolio volatility while increasing returns. Did you know that the largest pension funds, such as Canada Pension Plan or Ontario Teachers Plan, invest in a combination of both public and private investments? If the largest pension plans in the world are investing and creating wealth this way, shouldn't you be as well? To learn more, visit us at www.mandevilleinc.com. Mandeville Private Client Inc. is a member of the Investment Industry Regulatory Organization of Canada and a member of the Canadian Investor Protection Fund.